Sold at 560.
785 the first, 785 the second, be sure, 785 the third, and final time, sold. The third and final time at £910,000, sold. Well, welcome everybody to the Allsop Prop Chat. This podcast reviews the Allsop commercial auction held on the 20th of July. My name is George Walker, one of the partners and auctioneers in the team, and I've got my colleagues Will Clough and Ben Hodge joining me later on. Just a quick overview. What a busy day we had. £67 million raised, 84% sold. Nice stat. That makes 140 million in the last 5 weeks. So we've had a busy time and the market's responded incredibly well. This auction, probably what stands out, a lot of £1 million lots, 28 lots. Over a third of the lots sold were over £1 million, an average of 1.6 million. That's a very high stat for us. Interestingly, 55 million of the 66 was retail. But for some reason, this auction, we had £6 million offices. Hadn't had that for some time. So offices making up a good proportion from Upper Richmond Road in London to Scotland. So quite a varied geography, but office demand is out there as well as the retail demand. We're going to review today a number of different examples. We can't cover everything because we sold over 80 lots. We're going to pick out a few examples. As always, if you want to ask any particular questions, give us a call. And podcast ideas are very welcome at podcasts@allsop.co.uk. So anyway, let's turn to Will to look at some of those big lots I mentioned earlier. Will, what was the one, the TSB in Edinburgh you're quite familiar with?
Yeah, morning, George. Start with the biggest lot in the catalogue, that was sold in the catalogue. Lot 40 was the TSB in Edinburgh, as you say. It was a hybrid approach with our private treaty team, so it's been out in the market a little bit ahead of the catalogue release. 2026, a stunning looking traditional bank style building, and you're in the heart of Edinburgh. Probably as much a real estate buy as an income buy here. It was 2026, as I say, and probably reflected in that is the breadth of interested parties we had looking at it, from our traditional bank buyers to those that are seeing a bit of future value or alternative use there, including sort of boutique hotel sort of club operator as well, who will be well known to some who had grand plans for the future, but it wasn't to be for them. This one went ahead of 3.6 million, 7.5%, and quite a long way ahead of the recent valuation there. So one example of a big bank, and Ben's going to pick up on another big bank we had down south of the border.
Yeah, thanks, Will. So we sold a big bank, High Street, Hounslow. It was lot 30. This wasn't just a bank though, so it was a double unit let to HSBC on an overriding lease until 2029. Part of it was sublet, but interestingly, it was on a quarter of an acre site. So long term or medium term, it's got some redevelopment potential there. To the rear, there is a precedent for some residential development. So, the buyer might have some options.
About 15,000 overall, Ben?
There's about 15,000 square foot overall. So it sold on the day, £3.5 million, 4.4% on income. And on the square footage, it was £225 a square foot. It was actually eventually bought by an overseas buyer. So these things are getting noticed.
Okay, a bit of a theme from yesterday as well. We'll come on to the buyers later on. If you're a regular listener, you'll know that I bang on about Boots quite a bit. I think that medium-term value was really, really clear in some of the prices. We sold a dozen Boots assets yesterday. This is part of the portfolio that was re-geared some time ago by our clients. Some very, very good postcodes for the auction buyers in this one. And I'll pick out one example, which was the building in Southgate. We looked at the numbers on this. It's a nice 8-year lease. Southgate's a lovely spot in North London. We just felt we had to be guiding one of the lowest yields that ever guide anything out, 4.5%. That wasn't a ground rent. It's not a ground rent. It's a shop entirely let, 4,500 feet. And we let it go, and the market responded in a way that I don't think I've ever seen before. We guided it at 1.2, and we got 1.765. 1.765 is just under 3% for a retail asset. So this really must be reflecting the medium-term value when lease the lease to boots finishes in 8 years' time, what you can do with 4,700 feet in Southgate, 371 pounds a square foot. But really, I mean, the competitive bidding was extraordinary, but I think it was 50 or 60 bids. So really nice piece. The rest of the booths were in the southeast, and I think we were ahead of the valuation. The portfolio that we sold, a majority of the portfolio had been on the market with private treaty before, and we were certainly 20% ahead of those figures as we finished the day. Well, you worked in another portfolio, secondary, tertiary retail, but a vacant. So talk us through some of that.
Yeah, as you say, there was a big package in there. It was very geographically spread, often with short leases or potentially some asset management opportunities there, which makes it not that easy to price off the bat. But really reassuringly, there was much more appetite in the market than perhaps our initial pricing suggested. Now, we don't mean to be pessimistic auctioneers, but I think we like to price to the market. And this time the market proved that it was confident with the short leases in many instances, as I said, buying all over the country. And it really drove the pricing on there quite a long way of our initial expectations. So a real boost for that sector.
Some of that stock was difficult locations, wasn't it? I mean, towns that you wouldn't be on your shopping list, but the market just took it on.
I think people are now buying opportunity again. They were buying location, as is understandable last year. Get into the best locations you can, and perhaps now, as we ease out of full or the last of the requirements of lockdown on Monday, I'm not saying that was the turning point, but perhaps people are seeing now as a chance to buy a bit of opportunity again, and particularly where you can enhance it by getting your hands on it. One perhaps where there's not a huge amount of enhancement to do, but really surprised us on the pricing was in Whitehaven. Now, you couldn't really get further away and tucked away on the northwest coast. But this was as the stores until 2028, £100,000 per annum. It's only £7 a foot on a rental. But this did have a break in June 23, so potentially only 2 and a bit years of guaranteed income there.
Classic situation. You're trying to work out what that's worth from a desktop, and a break in 2 years' time. You've got to price in some yield there. So where did that end up, Will? What sort of number?
That ended up at 7.5%, which people are bidding through the breaks, and they're willing to pay for that. And it was actually bought by someone who'd bought another supermarket investment from us earlier in the year. That was in the northeast. Now flipped across the country and buying in the northwest. So I think it's great to see people returning, but also seeing people bidding beyond the breaks where the nervousness about them have perhaps gone. But I think on this one, it's linked to the tenant and the town and exactly what it is. So a bit more confidence there.
The other side of the really secure retail buyers have been hoovering up convenience income. I think the inflation story is coming to the property press quite quickly, isn't it? How do you think that's impacted? And we had a couple of RPIs and CPIs in the convenience store sector. Will, you got some examples of those? How's that?
Yeah, well, I think if we wind a year back, we sold quite a few convenience stores, and a lot of sellers who were going to sell them decided to hold on to them because of the security of income. So there's such demand for these sort of things, and as you say, 3 examples in this one, all let to the co-op. Wrexham Lot 9, that was 2036, no breaks. CPI reviews, that sold sub 5%. That was a pub conversion from memory with an extension on that. Lot 22 in Penzance, 2032, no breaks. CPI, that was 5.5%. And Lot 74 in Seaham, 15 years, no breaks. RPI this time, 5%. So strong demand for the protection against inflation, which, as you say, is widely talked about now.
Yeah, it's only going to help some of those assets, isn't it? So we talked about buyers briefly on the roundup. Ben, any other trends you can pick up on the buyers?
Well, I'm delighted to say after the last 12, 18 months where we haven't really seen too many overseas buyers come to the auction, mainly because of lack of travel and so forth, we have seen the return of the overseas buyer. Roughly 10% of the sales went to overseas buyers, which is encouraging news. As well as that, we saw a very strong presence from the local buyer. I could come out with a dozen highlights of well-competed lots yesterday, all of which got knocked down to local buyers. I'll only bore you with a few. Lot 30A in Beaconsfield. Lot 30A in Beaconsfield. This was remarkable. You had about 2 years of income guaranteed to a break to Crewe. Upper parts for 2 flats sold off. And this sold for £757,000, which was keener than 4.5%, sold to a local buyer. And another one, actually.
Reporting a lot of sales are better than 5%, aren't we? It's, some of the better stock yesterday was really, really, really bid for, wasn't it?
It really quite was. So another one that went to a local buyer was lot 87 Eastleigh. Now this probably falls within Will's bracket, which you can come upon in a moment, the alternatives. This was actually a vacant shop and a nightclub in Eastleigh.
That was no oil painting either, was it?
No, exactly. So it was one that really had to have some work, some development potential. We had 45 bids placed on the day, and that sold for £654,000 to a local buyer. So, as I say, we have many more of these examples, but it was encouraging to see the local buyer out and strong yesterday, and they really believe in their local high streets, and as has been touched upon already, the opportunities.
That's good. And no podcast could be complete without Mr. Alternative having his say in what's happening in that sector. Well, much alternatives.
I'll fire up the alternative sector. Just a couple. I think whether you call Eastleigh alternatives is a moot point. It's a redevelopment angle there. But just 2 things to round off, because it's mandatory now in every podcast we pick up something that's not retail, office or industrial. We had a little dentist in Oswestry, a new lease there for 10 years, but with a break in 2025. And that was small little lot size, and people seeing a bit of potential upstairs, although leased as a whole, 7.3%, so some good competitive bidding for that. And the long income children's care home, not too far from Kidderminster, with a huge amount of interest in that one, and a deal was agreed prior to the auction at that around the 6% mark. So yeah, we can call them alternatives forever, but slowly they are becoming more mainstream, and the prices people are willing to pay for these sort of sectors are huge.
Yeah, it is, as you say, it's become mainstream. It's a simple, decent, believable tenant, a believable rent, and a nice long lease, and people will buy that, won't they? Okay. Ben and Will, thank you so much for summarising it. That is a whistle-stop tour of a lot of sales. £300 million raised by us this year, success rate of 90%, which shows you how the market, we think, probably began to turn in February. And I think it's a very strong result. Over 400 lots sold there. And a heck of a lot of those were over £1 million. So a very, very good first half of the year. We're going to delve into some more detail at the end of the summer, probably in the form of a podcast or 2 for our normal half-year review. Meanwhile, do enjoy your summer break, well earned, as we sit here with 32 degrees promised in Cornwall. Again, we really would welcome your ideas. Podcasts at allsop.co.uk. Will Clough and Ben Hodge and I am George Walker, always willing to hear your ideas, and thank you very much for listening.